What's up, everybody? Steve Mortensen here, Coldwell banker, Yorba. Hey, thanks for coming back to my channel. Today, I want to talk to you about different types of financing that a buyer can use when purchasing real estate here in Orange County, California. All right, so let's get right into it. So today, there's about 3 categories I want to talk to you about. We've got traditional financing, we've got government-backed financing, and then we're going to talk about creative financing. So here's the details. Let's start with traditional financing. So when I say traditional financing, in the entirety of real estate, people have typically put down about 20% of the purchase price. Now that's no longer gospel in today's world, but we refer to that as conventional financing when you put 20% or more down payment. All right, so when it comes to conventional financing, you've got a lot of options, right? So you can get in for as little as 3% down on conventional financing. But as a reminder, any down payment below 20% down is going to require you, the borrower, to have mortgage insurance, which is an extra fee you're going to pay monthly. However, once you get to that equity cushion of 20%, because you either rehab the property and drove up the value, or you've paid down the mortgage balance and have got the equity cushion there, or just over time a combination of those where the property value goes up, you've paid down the balance and you've put a little bit of love into it. Once you get to that 20% equity cushion, you can petition your lender to drop the mortgage insurance. So keep that in mind. Anything below a 20% down payment is going to require an extra fee by way of mortgage insurance. But it can get you into the property market for as little as 3% down. Now, we don't see that a lot, particularly because here in Orange County, homes are so expensive. You need to have at least 5% down payment so you can get into the high balance conforming loan amounts. So for the year 2022, that's $970,000 is that conforming high balance loan amount. So theoretically, you could buy a home over $1 million and take a $970,000 mortgage with only 5% down. So that gets you into the housing market. More commonly, what we're going to see is probably the 10% down payment, and then we step right into the traditional 20% down payment. Now, the benefits again there are simply that you don't have to pay mortgage insurance. Mortgage insurance is not tax deductible. It literally goes towards nothing unless you were to default and not make your mortgage payment. What that does is that insurance guarantees that the lender will get their money back, right? And banks aren't in the business of losing money, but it's a big waste for you. So if you can get to 20% down, that's where you want to be. Let's move now into different types of government financing. So there was a period of time going back to the Great Recession, 2007, 2008, 2009. The only game in town, for the most part, was government-backed financing. The banks were reeling from catastrophic losses on the Great Recession. So the banks had really gone to the far end of really tightening down their criteria to be able to qualify for a loan. Even for the most well-heeled buyers, it was tough to get a loan. So the government options became the best. And the most prominent of those was what we call the FHA loan. Now that is a loan that is backed by the government's division of the Federal Housing Authority, right? And the beauty of the FHA loan is, again, it can get you, the buyer, into a property for a very low down payment. FHA loans require 3.5% of the purchase price as your down payment. But as we've discussed before, because it's below that 20% threshold, and it's government insured, you're going to be paying mortgage insurance, right? So that's one option. But again, it gets you into owning property and it's backed by the government. So the government, again, like I've said, wants people to be homeowners here in America. So one of the beauties of this FHA loan is they'll write a loan for a lower credit score. So if you don't have great credit, an FHA loan might be a good option for you. Additionally, another benefit of the FHA loan is the bank will allow for a higher debt to income ratio than on a conventional loan. So what that means is the bank looks at what is your mortgage payment going to be, what is your car payment, what are your credit card bills, and they stack all that together. Traditionally, banks don't want all of your monthly recurring payments to be more than 45% of your gross monthly income. That's how much you earn each month before the taxes are taken out. So they don't want that to be more than 45%. So for easy round numbers, say you earn $10,000 a month, the banks don't want all of your payments to exceed $4,500 per month. However, with an FHA loan, they will go up into the 50s. So if finances are tight, again, this is an option for you to be able to get into home ownership and extend your debt to income ratio a little bit. And for most people, they still find a way to make it work. So that's a great option with the FHA. There's another FHA loan, which is pretty rare, particularly in today's world, and that's what we call the FHA 203K. And what that loan is that is a government-backed loan. Again, the same benefits of the regular FHA, but it's designed for you to be able to rehab a property. So if you find a real fixer-upper and you want to jump in, the government will write that mortgage and they'll write in the rehab portion of it. So you'll be able to rehab that property out of the original loan. So again, that's a very, very unique loan. We hardly see it anymore, but 15 years ago during the Great Recession, we saw it quite a bit. The next type of government-backed financing is one that is reserved for Americans who have served in any branch of our armed forces, and that's called the VA loan. That loan is backed by the Veterans Administration, and it's only available to people who have been honorably discharged from one of our armed service branches. Now, this loan, in my opinion, is the creme de la creme of all loans. And let me tell you why. Because the government will back your mortgage if you are in one of the branches of the military to 100% of the purchase price, meaning the borrower literally puts $0 down out of their pocket. Now you still have closing costs, that's another conversation, but down payment, $0. Additionally to that, there's no mortgage insurance. So because the government is saying thank you to our veterans, you can buy a house with no money down. You get a rock bottom low interest rate because it's insured by the government, and there's no mortgage insurance. But again, that's only reserved for our veterans, so not everybody's eligible for that. And the third type of category that we're going to talk about is creative financing. Again, this is something we don't see a ton of today because the market is so hot, but there's a time and a place for everything. So let's talk one option. One option is going to be hard money financing. What that means is that you're not going to go to a traditional bank to borrow your money. You're going to go to a private lender who's going to loan some person's individual money to you, right? And so because it's a private person's money, their underwriting guidelines are much, much looser. They have all kinds of creative things that they can do. They will loan on the worst condition property you can imagine. They can fund those loans very quickly, sometimes in as little as 7 days. The catch is, because it's hard money, you're not gonna have a very good interest rate. Where in today's world, in late 2021, moving into 2022, you could probably get a mortgage from a bank under 3%. You better plan on paying 10% interest or more if you go the hard money route. So who's going to use a hard money loan? Typically, it's going to be somebody who's looking to flip a house, meaning they're going to buy it, they're going to rehab it, and then they're going to sell it on the back end when it's repaired. But every once in a while, we've got a borrower that can't prove their income, that has money, but they can't prove that they can make their monthly payment. Every once in a while, they'll use hard money just to secure the property, and they'll look to refinance with a traditional bank in the next 6 to 12 months. So that's hard money for you. Another creative financing option we have is seller financing. Again, this is very rare right now, but go back to the late 1970s and 1980s, this was pretty much the only game in town. That is where the seller agrees to become the bank. You offer the seller a price for the property, the seller's mortgage is down here, and the seller will tack a premium on whatever their interest rate is down here, so that each month the seller is making a little bit of interest for the benefit of you being able to buy the property, but they're earning money because they don't need all the equity out of their property right now. It's not very common we're going to see seller financing in today's world, but as interest rates rise in the coming years, this might be something that comes back up. Now, there's a few caveats to this type of financing, but we're not going to get into all of them right now, but it might be something we use in the future, so stay tuned for that. All right, so that wraps up our discussion on different types and categories of financing. Hopefully you found that information useful and helpful. Feel free to like and comment below. Let me know your thoughts. If you've got further questions on these things and you want to talk about them further, get at me. Until next time, we'll talk to you then.